Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter like we normally do. I'm going to share my financial opinions as we go through it together. It's generally related to wealth building, financial topics, and/or commodities. So let's get in there. I'll share my financial opinions on what's going on in the markets and what people are sharing. And if you want to follow me, it is at finding_finance. And if you want to join our community, finding-value.com, where I dive deeper into these topics, into individual companies, individual sectors, and I share my opinions about the companies a lot more freely than what I do on the YouTube channel here. We have a 7 a.m. question and answer session coming up on Saturday. And we also have the coupon code LEAP going on still, LEAP. Rana says, Goring and Rosenzweig, the world's two largest producers, are now both short of uranium. These inventories would soon deplete entirely, making this cycle different. We predicted the uranium bull market would soon become chaotic. That period is now upon us. So it says the world's two largest producers are now both short of uranium. It says we concluded these inventories would soon deplete entirely, making this cycle different from past bull markets. We predicted the uranium bull market would soon become chaotic. The period is now upon us. Now, we've got two conflicting pieces of information here. We've got the sector that looks incredibly good, but we've got the overall technology sector looking pretty weak. And sometimes uranium likes to hook on to the technology sector. What's going to win in the end? Is it the big macro picture, or is uranium's fundamentals for the sector going to win out? I don't know. I think it's two tugging forces, some of them on different time frames. I think the Nasdaq's going to tug it lower in the short term, but the fundamentals are going to tug it upwards in the short, medium, and long term, depending on how depleted these inventory levels really are. And I don't know where these levels are at. It's very hidden. So what I do is I don't try to time the market and try to time it in the extent that I'm not in it. I'm just going to stay in it and ride it because the fundamental background picture is so bullish on uranium that I just have to sit there. And if I have to ride through some volatility, if I have to go through a pullback because the NASDAQ pulls back and it pulls us lower, so be it. But the fundamentals here are really good and they are improving with time. And that's generally where you see your opportunity, is where you get a short term market pull down, like from some other sector like the NASDAQ. And then the fundamentals stay good and continue to get better. And that's your opportunity to identify the difference between short-term market sentiment that pulls us lower for whatever reason, and then the longer-term fundamentals of the sector. It's exactly what I look for, and that divergence. HFI research says an alarming trend is developing in U.S. shale oil production. So HFIR, U.S. Oil Production Composite Index, we've got the leading indicator, and then we've got the HFIR Production Composite Index. And over time, some of these overlap pretty good. But for some reason, since June of 2020, we've got this delta between the leading indicator and the HFIR Production Composite Index. Almost like production can't keep up with this leading indicator. So do we have a problem where production could roll over? It kind of looks that way, if you ask me. Looks like it wants to roll over or go sideways at best. Another one from HFI. If you're a nat gas bull, you are really an AI data center bull. If you break down IHS's latest outlook to 2028, you will notice a startling figure, power burn. If AI is going to take off, we're going to see higher power burn. The fact that IHS is forecasting -6 is crazy. So demand for power, we are going to be short -6, which is crazy, I guess. So we need to up our power supply, and that's mainly from nat gas. Investing is a simple business. It requires qualities of temperament way more than it requires qualities of intellect. You must supply the emotional discipline, and I agree with that. Emotional discipline is the game that we are in for being investors. Another couple of quotes here. I don't think you can get to be a really good investor over a broad range without doing a massive amount of reading, says Charlie. And then Warren says, my policy is reading every annual report and site that can further my knowledge about anything. JC says it hasn't stopped. It's been the worst trade in the world for years. Bonds just keep getting smacked in the face. Lower, we've got bonds versus stocks. Stocks are outperforming. Bonds versus commodities. Commodities are outperforming bonds. And then gold versus bonds. And gold is sweeping bonds under the rug here. It's just killing it. Brian says stocks are not risky. They only become risky when your holding period isn't long enough. And that is straight fire there, guys. That is correct. Blake says Lifetime Fitness in Buckhead, Georgia is $300 a month. Who in their right mind would pay $300 for a gym membership? You know, our gym membership up here at Lifetime Fitness, and no, I'm not a member, it's like the same price as that. I don't know who the heck pays that. And people who think that we're in some sort of recession, I don't see it, guys. There are a lot of things that people pay for that I consider to be absolutely ridiculous in terms of pricing. This gym membership, $300 a month gym membership, is one of them. And then you look at some of the sports that the kids play, and that's very expensive. And I just wonder, how are these people affording this? Like, I mean, some of these people, they might pay $2,000 a month for their kids and their gym memberships and all this stuff. And I'm just like, wow, that's a lot of money. If their kids are in, let's say they're in cheer, you've got a gym membership, you've got other memberships to other things that these people do. And I'm starting to add it up. I'm like, man, that's well over $1,000. It could be $2,000 a month. Rhodium is up 14% today, usually is a pack leader for platinum group metals. And that is interesting. I did check the platinum or the rhodium chart. Look at the volume too. It's looking pretty good. So rhodium could be bottoming here, guys. Up 14%. I love it. We've got, it's boring because the real return is effectively zero over 50 years. And this is the US M2 money supply versus the S&P 500. Notice that they are very close, and the S&P really isn't given that much of a return over the M2 money supply. And this guy is responding to the boring 8% return in the stock market is only boring because you don't have a lot invested. Getting 8% on $500,000 portfolio is a 40% gain. That's not boring. You focus on larger principal amount. And this guy's just saying, look, you're barely making any purchasing power gains. And what's even worse is if you look at the after-tax amount, it makes everything look even worse. Cash is going to bleed out of the debt market and put massive pressure on the stock market. This is going to lead to a meltdown in the debt market that is going to be epic, says Gregory Mannarino. And I agree. Interest rates are going to go up because of the bond market, and interest rates are going to put a lot of pressure on the overall stock market at some point. And that's where you're seeing gold diverge from bonds in 2020, 2021. That's one of the reasons that it is diverging. Its money is starting to seek other alternative assets. And I think that trend will continue. I love it, Logan. So Nick Gurley, this guy who continues to call for a housing crash, like every year since 2020, that's when I started like my YouTube channel. And one of the reasons why I started it was because this guy keeps calling for a crash. And I'm like, gosh, this guy is so wrong. Logan says, please, no one ever CC this guy to me ever. I love it. I love it. Because I feel the same way when people link information from Nick to me. And it's like, this guy just doesn't know what the hell he's doing. It says, why have home prices surged in 2020? Because the supply of homes for sale, aka inventory, has plummeted. However, don't expect this trend to continue into 2021. This guy's been wrong for 4 years straight, guys. 4 years straight. Maybe even longer than that. He's probably calling a housing bubble in 2018, 19, all these years. These guys have no idea what they're doing. And I've even looked at some of these other um, people on Twitter, even. And, what is it? Danielle DiMartini Booth, she always talks like we're in this big housing bubble. I'm like, have you not seen the data? I don't understand what you are looking at. And it's not, the reason I don't understand is because she doesn't understand what the data is, in my opinion. And same with this guy. They look at the data and they come with these like far-fetched conclusions. And I just look at it like, I mean, I don't even know if I could come to the same conclusions when I was like 12 years old. I don't know. I mean, I don't know what they're looking at. Here's LNG, nat gas. So U.S. LNG export buildout. We have the big wave one LNG buildout that completed in 2023, basically. We've had a slowdown from 23 into 24, and then the second big LNG buildout that's underway starts in late 2024 and all the way into 2030. So we have the big second wave coming. This is going to be takeaway capacity for natural gas. And what I'm interested in is what does that transition look like from 23 into 26? What are inventories going to look like? And do we have to build the inventory up and then yank it out of inventory to kind of buffer us against increasing supply? I don't know. But this will be an interesting transition. Biden is proposing a 44.6% capital gains tax, the highest ever, previously set by Jimmy Carter. Here's how that worked out for Jimmy Carter. So Carter got no votes versus Reagan. Maybe that's what Biden's doing. He just wants to give it to Trump, I guess. But that's what we've got here. Here is Game of Trades. He says home buying conditions have fallen off a cliff. Current levels have never been seen since in the last 60 plus years. Yeah, I would also not feel like buying a home if I couldn't afford one. Affordability is really bad, and the buying conditions are about as tight as they've been in history. Does this mean that we are going to get a crash? Well, I don't necessarily think so. This was a housing market crash. This one too. We overbuilt, overbuilt, overbuilt. We overbuilt in 1990 here too, as well. 90. We overbuilt here in this recession here, but we're not overbuilt. And I know a lot of people they're showing like new new homes in inventory, like that's the total process. I just don't think there's a lot of people that understand the data that they're looking at that well. But this is data here. They don't feel like buying homes. That's an emotional state, which that's fine. But that also means that we're in a pretty tight market. And affordability is bad because it's tight. Shanghai silver versus COMEX silver, $30 versus 27, and the physical continues to move from west to east. Katusa Research says silver has underperformed gold by 78%. History shows that this can change fast and both make powerful moves. So silver's underperformed gold by 78%. Will silver play catch up this cycle? Probably is what my guess would be. Marion Katusa again, commodities are the cheapest they've ever been compared to the S&P 500. Copper's risen 11% year to date and 25% over the past 3 years. Silver spiked 18% year to date. It's an 11-year high. Uranium hitting 15-year highs. But the silent bull market the average investor isn't seeing is gold. So S&P commodity index versus the S&P 500. Equities are expensive, commodities are cheap, and that is a generally good location to be looking in all of these areas. So that looks good, and commodities are favorable. We remain bullish. This is crude and gasoline and distillate inventory levels. We are declining. The one above that, this is the 2016 to 2019 average. We are below the average, and we are most likely going to continue lower over the coming weeks, where it looks like most years bottom towards week 40 or 42 towards the end of summer driving. Tavi says, for those who appreciate key technical levels, the U.S. yield curve steepener trade is on the verge of a significant breakout. And if it comes to fruition, I see considerable potential for upside. To put this into historical perspective, while the spread between the 2 versus 30-year yields remain in negative territory, after a major inversion, the yield curve tends to uninvert by over 400 basis points. We appear to be witnessing a similar trend unfolding presently, not to mention a steepening yield curve after being deeply inverted also tends to be a precursor to a recession. So it looks like we could potentially be breaking to the upside where we could see the likelihood of a slowdown or a recession if and when this inverts and comes back up. That's generally when it occurs. So that is a possibility. We are seeing weakness in technology stocks in the NASDAQ and the S&P 500. It all kind of aligns together here where we could see a potential slowdown in the overall markets. And that will impact commodity. That could very well impact commodities too. Comparative inventory analysis for 424, 3.7 million barrel draw. Wow. Implied WTI fair value price of $80 or $3 overvalued from the current price level, given this historical dot plot of price versus inventory level. Cuppy says, feel like bonds are about to get carpet bombed, are about to carpet bomb the equity land. Stay safe. And that's interest rates going up and the pressures that those interest rates apply to the stock market is what he's saying. Cross-border capital says, whoa, 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 whoa. Are U.S. Treasuries term premia breaking out higher? So are we breaking out to the upside? Think of it as interest rates. So yeah, it does look like it's breaking out to the upside. Last time we had a similar situation like that, we had a big move in 2021, and that's where we had big moves in our commodity stocks. So maybe we've got the similar conditions here where we might go and break to the upside. But people are going to say, well, what about this up here where we have a potential recession? Well, it hasn't broken out yet. We'll see. And that's really, you get these conflicting pieces of data all over the place in the market right now. It's not all aligned to one side. A lot of it is against each other, I should say. So here's boom. This is week ending 19th of April. Crude is down 6.368 million. Cushing's down 0.7. Gasoline 0.7. Distillate's up a little bit. Colin Robertson says home builders and their in-house mortgage lenders are having a moment. Pulte Group, the nation's third largest builder, just announced a capture rate of 84% in quarter one, meaning most homebuyers are opting to use their captive lender. Simply put, it's almost impossible for outside lenders to compete with builders offering massive mortgage rate buydowns. Their ability to offer below market rates may also explain why the company saw an 11% increase in home sales compared to a year ago and record home sale revenues during the quarter. And despite interest rate headwinds, their average sale price only fell 1% year over year to $538,000. Pulte Group President and CEO Ryan Marshall said the release, after more than a decade of underbuilding, it is estimated that our country has a structural shortage of several million homes. Combined with existing home supply locked in, it seems like a pretty good time to be a home builder. Yes, it is. And this is where I don't understand where other people are so bearish on homes. What people will say that are housing bears is they'll say, oh, they have, in order to sell their homes, they have to lower interest rates. And I'm like, yeah, but that's the exact reason that they're going to sell so many new homes is because they have the advantage of lowering the interest rates through lending And people are going to prefer to buy new homes, which means you're going to get a new loan against a new home, which is inflationary. So I think that's their advantage, not that the market is weak. The affordability is what's tough. And when you have tough affordability, they are making the affordability better to create the sale, which is great for new home builders. Brian Graff says wrong. The other chart shows that demand increased so much that it created a sudden shortage relative to demand. Starts are not plummeting. This is housing under construction is at record highs. And that is what's going on is we've got lots of construction. Looks like here a lot of apartments and other, but that's to house all these people. And what he's responding to is this. He says, "How this guy says housing starts plummeting. Good night, Irene." But this is not housing starts. It is the housing supply deficit hits a new record. The deficit in Canada is massive, and this is Canada up here, just to let you know. But Canada, this is kind of the average here. It's around a little bit of a deficit just underneath. So this is people per housing unit started on an inverted scale. And right now we've got all these people in Canada, and the deficit is growing. And this is the response to that deficit. So this guy's completely wrong. I understand a lot of people looking at data. They must not know how to read it. I don't know. Here's Lynn Alden. It says, ironically, the reason that houses often become a decent investment in practice is not necessarily the house itself, a depreciating non-scarce asset, but rather the fiat currency short, the mortgage, and the forced monthly savings rate building equity it comes with. So a lot of people are dissing the housing market and buying a home, but locking in your expenses is where the money's made. And if you can lock in a mortgage rate that's underneath the inflation rate, you win huge. That's what I've done. Rates are already higher for longer. Historically speaking, it takes on average of 8 months from the last rate hike for the Fed to start cutting rates. With the last rate hike being in July, we're already 10 months out with no cuts. In fact, discussions of more rate hikes are returning rather quickly. As inflation is back on the rise, it's unlikely we see any rate cuts before September of 2024. This would mean 14 months or more between the last hike and first cut. It's a rather unusual time for the economy, and this will be one of the longer times where the Fed is keeping interest rates higher for longer than normal. And that's the length of time from last hike to first cut. We're at 10 months right now, and the average has been 8. Maybe this cycle is a little bit different. Maybe it's going to go longer than all the other ones. Gold trading volume in China has exploded to 5x the average in 2023. So yeah, they're getting on it, guys. They are all over gold. We've got copper and silver have had high correlation and exact same return since 2000. So same return since 2000, copper and silver. Silver being a little bit more volatile, both on the down and upside almost. You can see that. API inventory bullish, minus 3.23 using that data. And that's where we're going to end it, guys. That's what we've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We'll see you guys at 7 a.m. On Saturday, who are members that are going to attend the question and answer session. All right, guys. We'll catch you later. This is Finding Value.